Life insurance. Who needs it? You do, and here's why. 1. Financial security for you and your family. This would be especially true for the loss of the major income provider in the household. 2. If one of two partners passes, it minimizes the negative effects of maintaining a lifestyle. 3. The right type of life insurance can provide a basis for retirement, college funding, and purchases such as buying a car. There are many types of life insurance, but in this video we'll be discussing term life versus whole life. With so many different types of policies out there, it is extremely important to understand the particulars of any life insurance you are considering. Here, we will only be covering the basic differences. If you have questions or want more information, please call, text, or email me. As always, answers and consultations are free. What are some of the differences between term life and whole life insurance? Term life has a contract period of 5, 10, or even 20 years. The period of time in the contract determines your cost during that period only. Your cost is also based on your age, gender, health, and certain lifestyle characteristics such as smoking. With this type of policy, for example, if you have a 5-year contract, when you renew for another 5 years, your cost will increase for the new period because your age at the time of renewal is a determining factor and will be for each renewal period thereafter. If the policy owner dies during the contract period, the face value is paid to the beneficiary. The beneficiary has the choice of receiving the entire lump sum or have benefits paid over an agreed period of time. The cost of whole life is also based on your age, gender, health, and certain lifestyle characteristics. In other words, you jump out of planes. The policy price is based on your age when the policy is issued. Your monthly cost remains the same throughout the life of the policy. In other words, there's not a price increase every 5 or 10 years as there is with term life. Whole life policies can be paid off in 20, 30, or whatever years you determine. Again, the policy owner dies during the contract period, the face value is paid to the beneficiary, and the beneficiary has the choice of receiving the entire lump sum or have benefits paid over an agreed period of time. So what's the difference? Let me give you an example. Because I wasn't knowledgeable at the time when I was in my late 20s, I purchased a term policy for $50 a month. Now, 50 years later, that same policy is costing me $1,500 a month for the exact same coverage. I wanted to share this with you so you don't make the same mistake. Please call, text, or email me if you have any questions. All consultations are free of charge. Have a good one.